Since we are in business, the expectation is that we will offer credit to our customers. However, the issue here is that we are not a finance company, and our goal is to see how fast we can collect those accounts receivable from our customers. So we need to make sure that we have a very strong management policy when it comes to accounts receivable. So here are the 5 steps to make sure that you manage receivables effectively. First of all, determine whom you're going to extend credit to. Not everybody is credit worthy, so you need to be able to determine who are the customers that you are willing to extend credit to. The advantage of extending credit is that the customer hopefully will buy more products from you or acquire more services from you. However, you do want to make sure that you get paid by that customer, so you want to make sure or be very careful who those customers are that you extend credit. When you do extend credit, one of the things that you want to make sure is that you establish what your payment period is, and that what your expectations are of your customers to be paid. That's the reason why you set up the credit terms of the 210 net 30. Our expectation is the net 30 that we will be paid within 30 days of the date of the invoice. Once you've extended credit and you have sold product to your customers, you're not done. You want to make sure that your customers pay you. So you or someone within your company needs to monitor the collections of accounts receivable to ensure that you do not have any customers that start falling behind in the payment of the accounts receivable. Typically, larger companies will have credit managers who will make the decision about how much credit to extend to a customer, and they will monitor those collections, and at the point a customer is not living up to their obligation of paying you, that credit manager will make the decision that that customer will no longer be able to buy on credit terms. Finally, you need to evaluate the liquidity of the receivables in terms of how current those receivables are and what's the likelihood you're going to collect. For most companies who have limited resources, the sooner you can collect on those accounts receivable, the better situation you'll be in. So we need to determine when we expect to be collecting the accounts receivable from our customers. In the event that we think that there will be an extended period of time in which our customers will be paying us, we may need to determine an accelerated method to get cash from our receivables so that we are not in a situation where we run out of cash during our daily operations. So as we look at this, when we extend credit, we don't want to be too tight on the credit because our customers will go somewhere else. However, we don't want to be too loose because we want to make sure that we extend credit only to those customers who will pay us. So it's really important to check credit references and also business references to make sure that the company you're doing business with is a viable company. We need to establish a payment period. Most companies need to determine what their acceptable payment period is, and that they need to tell their customers what that policy is before the sale occurs. We want to make sure that payment period is consistent or better than our competitors so that we can attract customers to want to do business with us while we still want to control the amount of credit we issue to our customers. We want to monitor the activity of our customers because we want to make sure that they pay us on time. One of the risks a lot of companies run into is when they extend credit to their customers, they extend too much credit. In fact, there are situations where there have been companies who have extended credit to primary customers who do a significant amount of business with them. Now that sounds very lucrative and exciting when you have a big customer buying a lot of product from you. The problem that you run into is that you bear the risk of what happens if that customer can't pay you any longer. You now have the exposure of a large accounts receivable balance, and a customer who cannot pay that large account receivable balance can essentially hurt your business because they don't pay their debts on time. So one of the things that we want to do also is take a look at the liquidity of the receivables. So there are two ratios that you need to take a look at for accounts receivable. Very similar to inventory, we like to calculate the accounts receivable turnover. The accounts receivable turnover is the amount of times that we sell a product to a customer on credit and collect is one turnover. So if we say that our accounts receivable turns over 12 times a year, collections of a sale happens once a month. The formula for accounts receivable turnover is net credit sales divided by the average net accounts receivable. Now, when we say the average net accounts receivable, we're saying take the beginning balance of the net accounts receivable plus the ending balance of the net accounts receivable divided by 2. So as you look in this example here for Nike, the ending balance of March 2010 is $2,650. The ending balance in 1 year is the beginning balance in the next year. So the $2,650 is the beginning balance for 2011, and the ending balance for 2011 is the $3,138. Add the two together, divided by 2, and that gives you the ending accounts receivable. As we look at Nike in 2011, the accounts receivable turnover was 7.2 times. In 2010, it was 6.9 times. As an outsider looking at those two numbers, in 2011, Nike was collecting their receivables better than in 2010. So the higher the number, the better the operations. The average collection period formula is 365 divided by the accounts receivable turnover. This basically tells us how long it takes to collect a receivable. So in the case of Nike, in 2011, it took them 50.7 days to collect their accounts receivable. Now that is better than 2010 because in 2010 it took them almost 53 days to collect. So their collection policies are better in 2011 than in 2010. So, accounts receivable turnover helps us to determine the liquidity of the receivable, how quick we are collecting on the accounts receivable. The average collection period tells us how long it takes us to collect those accounts receivable. To improve cash flow, many times companies consider accelerating their cash receipts. There are 3 reasons why companies may consider the sale of their accounts receivable to outside parties in order to accelerate the cash. Here are 3 reasons why we may want to accelerate the collection of cash by selling the accounts receivable to an outside party. 1, the size of the receivable. The larger the accounts receivable, the higher risk the company is taking in holding that receivable. In the event that the customer does not pay that accounts receivable, a large dollar amount in accounts receivable could put the company at risk. For cash flow reasons, selling the accounts receivables may be the only way to generate cash quickly for some companies to continue their operations. Finally, one of the other reasons to sell a receivable is the effort it takes to bill and collect on accounts receivable can be substantial. The easy way is to sell the receivable to a third party and let them collect the accounts receivable. The issue that you run into when you sell the accounts receivable, you'll have to sell the accounts receivable at a discount. If you sell it at a discount, you're not going to collect the entire amount on the receivable. The purchaser of the receivable is going to want to take a percentage as their fee for taking the risk. So when we sell a receivable, we're selling it to a factor. So a factor is a finance company or a bank that buys the receivables from the business for a fee and then collects the payments directly from the customer. So here's an example. Assume that Henderson Furniture factors a $600,000 of their receivables to Federal Factors. Federal Factors assesses a service charge at 2% of the amount of the receivables they purchase. So Henderson gives up $600,000 in the receivables for $588,000 in cash. Federal Factors charges a $12,000 fee for their service. So we would do a debit to cash for $588,000, debit service charge expense for $12,000, and credit the accounts receivable for $600,000. Once you sell the receivable, it doesn't belong to you anymore, so you need to take it off the books. For many companies, a choice needs to be made as to whether to offer accounts receivable or to take a credit card. Credit card sales can be treated just like accounts receivable if there is a delay in the receipt of the cash from the credit card company. Most banks provide credit card services and will put the cash into your bank account on the same day as the sales transaction. If that occurs, we treat the accounts receivable as a cash transaction being provided by the credit card company. The credit card company charges a fee for their service, but at least we get the cash sooner. So let's take a look at an illustration. Morgan Marie purchases $1,000 of compact discs for her restaurant from Songrowth Music Company, and she charges this amount on her Visa card. The bank service fee that First Bank charges Songrow Music is 3%. So Songrow Music has to do a journal entry because they received the money from the bank the same day the sale occurs of debiting cash of $970, debiting service charge expense, which is charged to the company, of $30, and then they recognize the sale of $1,000. So the $30 is the service charge charged by the credit card company. For many customers, that credit card charge is a convenience to both the buyer and the seller. The buyer prefers to use a credit card because they get extended payment terms. The seller likes the credit card because they get the cash sooner. They don't have to wait the 30 days that typically most companies take to pay an accounts receivable. Now, the one item that could change this is if the credit card is a credit card company that pays other than the day of the sale. Credit card companies similar to American Express and Diners Club do the sale transaction. However, they do not put the cash in the seller's bank account from anywhere from a week to 2 weeks. If that occurs, the journal entry would have been, instead of to cash, but accounts receivable to the credit card company. So think about this, is which way is better, credit card or accounts receivable? In either case, it's important to be able to offer this to your customer, but control it to make sure that you get your cash in a timely method.